Okay, you have seen the headlines. It feels like every single day another tech giant is announcing some massive, multi-billion-dollar investment in artificial intelligence. The hype is just absolutely off the charts. It's a full-on frenzy to pour money into the next big thing.
But here is the real billion-dollar question. When a company makes one of these huge announcements, does it actually pay off? Does it move the needle for shareholders? Does Wall Street actually reward them for it? Well, as we're about to see, the answer is pretty shocking and probably not what you're expecting.
So first, let's just wrap our heads around the sheer scale of this investment craze. It really is a global gold rush for AI dominance.
I mean, you see headlines like this constantly, right? Take Microsoft, dropping a cool $3.3 billion on AI and cloud infrastructure, and that's just in one region.
And hey, it's not just the usual tech suspects. You've got major players in finance, like Visa, launching a $100 million initiative just to get ahead in the generative AI space. The spending is massive, and it's happening across pretty much every industry you can think of. So, to cut through all this noise and figure out what all this spending actually means for investors, a group of researchers did something really smart. They took a close look at 88 different AI investment announcements made by S&P 500 companies over a 4-year stretch. This gives us some fantastic, solid data to see the real impact.
And the key metric they used is something called abnormal returns. Now that sounds a little technical, but it's actually super simple. It's just that little extra jump or drop in a stock's price right after a big announcement, when you filter out all the normal everyday movements of the market. Think of it as a pure signal of what Wall Street really thinks.
All right, so we've got billions of dollars flying around, and we've got a clear way to measure the impact. Let's get to the juicy part. How does the market actually react to all this?
Now, your gut instinct, my gut instinct, probably tells you the stock price shoots up, right? I mean, a company is investing in cutting-edge tech in the future. That's got to be good news. But is it?
Get ready for this. The average abnormal return for a company that announces a major AI investment all on its own is 0.021%. That is so small, it is statistically indistinguishable from zero. For all that hype, all that spending, the market basically just shrugs.
But it gets even crazier. The researchers thought, okay, maybe the market only rewards the truly groundbreaking AI projects. So they split the data into two piles: standard AI adoption versus genuinely innovative, first-of-its-kind stuff. The result? It made absolutely no difference. Even a revolutionary solo AI investment failed to generate any significant value for shareholders.
So what in the world is going on here? If going it alone, even with incredible technology, doesn't work, what does? Well, the answer isn't in the what, it's in the who. It all comes down to collaboration. This chart tells the entire story. On the left, you see that solo AI investment gets you basically nothing, a flat line. But look what happens when a company announces that same investment as part of a partnership or an alliance. Boom, the market reacts positively. And what about that last bar? An innovative AI project announced within a partnership. That is the jackpot. That's where you see the biggest, most positive reaction.
The researchers themselves put it perfectly. They found that, quote, only the combination of innovation within strategic alliances is awarded by the market. It's not about the tech in a vacuum. It's about the team-up.
So this begs the question, why? Why does Wall Street care so much more about who you're working with than what you're actually building? Well, the logic behind it is actually very, very sound.
It really boils down to three main things. First, alliances help share the immense financial risk. These AI projects are insanely expensive, and nobody knows for sure if they'll work. Second, you get to pull your skills and create a kind of dream team. One company might have the data, another the algorithms. No single firm can be the best at everything. And finally, and this is huge, it just signals a much more credible strategy to investors. It shows you've built an entire ecosystem, not just some isolated pet project.
Now, this might look a bit complicated, but it's the researcher's data model, and it basically confirms everything. If you follow the path for a solo investment, it leads to a dead end. But a joint, innovative investment, that's the direct pathway to those positive returns investors are looking for. It's like they've mapped out the proven formula. So, what's the big takeaway from all of this? How should we really think about the future of AI investment? It's all about shifting our perspective away from the tool and onto the team. What this research demonstrates so powerfully is that the smart money isn't just betting on a single company's cool new tech. It's betting on the strength of their collaborative ecosystem. The real value isn't in the AI alone.
It's in the network that's built around it.
And that leaves us with a final, crucial question to ask ourselves. The next time you see a company make a major AI announcement, don't just ask, how good is the tech? Instead, ask, who are they building it with? Because the answer to that question is what truly seems to determine whether an AI investment is actually going to pay off.